I love this show, The Princess Bride, the movie The Princess Bride. Bobby, you ever see The Princess Bride?
I have not, but thank you for making me feel lost even before we start. What a great welcome, everyone.
I throw her under the bus.
I've never seen.
I throw under the bus immediately.
I haven't seen any classic movies, so just get ready for this to be a recurring theme, guys. All right, go for it, Joe.
The Princess Bride. There's a line in there where they say, that may not mean what you think it means. And I was a financial planner for 16 years and saw lots of things during my career, but I remember so many cases where that line, this may not mean what you think it means, came into play. I remember, for instance, one couple coming to me, they'd done the math on tax brackets, and they realized because they'd gone from one tax bracket to another, that if one of the two of them didn't stay home with the kids, the second person's income was going to be completely swallowed by taxes because of the fact that when you enter a new tax bracket, they'd pay a ton more tax, and it was going to get rid of all their money. And then I explained how tax brackets work. Once again, Princess Bride, that may not mean what you think it means. This may not work the way you think it works. And when I explained that, I said, this is either good news or bad news. The good news is you get to go to work. Or the bad news might be you go to work.
Joe, the music ran out on you.
Live from my mom's half-finished basement in Texarkana, Texas, it's Money in the Morning. Hey there, stackers. I'm Joe Salciha, Average Joe Money on Twitter, and welcome to the show where we go over not one, but two headlines ripped from the financial press. And not only do we read them like some sites do, we actually explain them. And we've got quite a show for you today where we've got not one, but two different headlines. And we're going to put them together into something we call the big idea at the end of today's show. Today's show is brought to you by Lemonade. Forget everything you know about insurance. Instant everything, killer prices, big heart. Check out their prices by heading to lemonade.com/lemonade. That's like the drink lemonade. StackyBenjamins.com/lemonade. And not only will you then be able to check out Lemonade while you're comparing prices, you might have happened what happened to me, which is I saved just a ton of money, which was pretty exciting. All right, we got a big show today. We've got Bobby Rebell with us. But of course, it wouldn't be a Stacky Benjamin show, Stacky Benjamin's produced show. It wouldn't be a Money in the Morning show if we didn't have troubles with our platform. And because we know that this is live in front of a Facebook audience, by the way, if you want to hang out and see today's train wreck, head to facebook.com/istackbenjamins, and you'll see that our platform Be Live today is really having a good time. But just to update our audio listeners, I just rebooted while I went through the entire open, and we are joined by our brand new host on this show, Bobby Rebell. Isn't this fun?
Oh, hey, this is so fun, Joe.
Yeah.
I love the way you just hanging there. I'm just sitting there hanging out with our Facebook friends, which, by the way, I can see who's on, but I can't read their comments. So I can see like a few faces and I know that people are watching, but I'm just hanging here waiting for you to come back, basically. And I'm off to the side. And what I'm doing, if people saw I turned to the side, I was kind of trying to communicate to Joe on back channels.
It's so funny because not only have we, we were going to joke about not practicing this. We practiced this 100 times. Paulette is here. She said, this is what soft launches are for. Yes, this is a soft launch, Paulette. This is exactly that. So the one time that our platform Be Live decides not to work is the time when we think that we might have everything together. But if we had everything together, it wouldn't be a Stacky Benjamin's production. So there you go. All right. You ready to do this?
All right. So we're just blowing past that open.
Well, let's just have Laura kick this thing off.
All right.
And now, your first Money in the Morning headline.
Well, Bobby, you don't know this. We actually did the open as we were going. So if you listen to the audio version of this podcast, we just continued right along very smoothly. Awesome. The audience, the Facebook audience didn't get to see what the hell we were doing, but
We didn't see anything. He just went to black. I just hung out and was like, I'll just sit here and wait.
It's
till told otherwise.
fantastic. Our first headline comes to us from the New York Times. Hospitals must now post prices, but it might take a brain surgeon to decipher them. You brought this to the table, Bobby, and said, we got to talk about this.
We do, because I mean, how often do we as personal finance advocates for consumers tell people to actually look at the prices before you buy something, maybe even try to get a better price? But when you do anything medical, for the most part, you're basically going in blind and you just get the price and you get the bill when you're done, and that is that. So it's a good thing, and you would think a pretty basic thing to actually tell people the prices, but it's not that simple.
Yeah. Well, let's see what's going on here, because the piece is written by Robert Pear and starts off this way. Vanderbilt University Medical Center, responding to a new Trump administration order to begin posting all hospital prices, listed a charge of $42,569 for a cardiology procedure described as HC space PTC space CLOS space PAT space DUCT space ART. I mean, that's $42,569. I've always wanted an HC PTC close pat duct art.
Of course.
Baptist Health in Miami helpfully told consumers that an Embolza Protect 5.5 would cost them $9,818, while a Visceral Selective Angiorad, oh, I love those, runs a mere $5,538. On January 1st, hospitals began complying with the Trump administration order to post list prices for all their services, theoretically offering consumers transparency and choice and forcing healthcare providers into price competition. It's turning into a fiasco. This policy is a tiny step forward, but it falls far short of what's needed, said Jeannie Pinder, the founder and chief executive of Clear Health Cost, a consumer health research organization. The posted prices are fanciful, inflated, difficult to decode, and inconsistent. So it's hard to see how an average person would find them useful.
Yeah, that was a mouthful, but yeah, exactly. So, I mean, this is kind of like when the food, they started talking about the ingredients in the food products that we buy, and it was just a mishmash of information, and no one could really understand what it was. And they would say, oh, something has 100 calories, but the portion size was inconsistent. So you didn't know. So you buy something, you think, oh, it has 100 calories. It's like, well, no, 100 calories per bite. So hopefully they will standardize this in some way that will make sense for us. And I do, by the way, I do want to point out, this is not a political thing, or at least it actually started out as part of the ACA, the Affordable Care Act. And it's really just now actually being put into place. It's actually being enforced, and hospitals are being asked to comply. But this is something that came up through the Obama administration's Affordable Care Act. Just so
Got it.
people
So,
know the context of it, because the headline does make it sound like it's the way the piece is written, that it's a Trump idea.
Well, but it really, yeah, and this idea of lower healthcare costs, I think, is a bipartisan thing. I mean, even with the fights, the policy fights on Capitol Hill, that everybody wants to see more disclosure and lower prices. I mean, I can't imagine anybody voting against that. So, I mean, to that degree, it's good. But what can we do with this? I mean, like the woman in this piece said, we need the next step. Like, this is baby step number one in a line of maybe, 50 baby steps?
Yeah, I mean, first of all, we need to put it into English. I mean, you read it as if it was English, but it really is not. It's a bunch of different codes, and that's not really helpful. It needs to actually be spelled out in a way that people can understand it. And people also need to be proactive and educate themselves about what their own resources are. And by resources, I mean, they might be covered under insurance. So these are sort of like rack rates when you go to a hotel. These are the retail sticker prices. Like when you, for example, Joe, you recently bought a car. So there's the sticker price, and then there's the price that you pay if you're in insurance. You pay a different price if maybe you're on Medicare or even Medicaid, or if you're in a different kind of high deductible plan. And then there's also the price that, frankly, you can negotiate. If you don't have insurance and you go to a hospital and you get a bill, you can also say to them, this is not going to be workable. Can you work with me? And we can find a way to resolve this bill together. And so it's important to not just take the price as is and say, okay, that's why it is the price. It's important to figure out what you're entitled to in terms of what you actually pay and be your own advocate.
I think that's important for people to know, is that insurance companies don't pay these rates that, these rates that we're seeing now, 42,000 or 5,500 or wherever it might be. So if you don't have insurance and you're trying to negotiate your own rate, you're trying to pay cash, it's important for you to do the same thing. Like, don't accept these rates.
Right. Exactly. I mean, like every other consumer expense, you need to be your best advocate and get the best price that you can get and shop just like anyone else. Of course, in some emergency situations, you're not going to be able to do that. But even after the fact, you can go to the hospital and say, look, you need to work with me or we're going to have a problem. Because ultimately they want to get paid something.
I'll tell you, for
and
people,
they know.
Yeah, right. For people that have a side hustle, you might want to join the chamber. Like if you're not comfortable doing negotiating, if you have a side hustle, if you have a part-time job where you can exert some influence, joining the Chamber of Commerce is something that you might be able to do to get at least a minimal health coverage so that they negotiate on your behalf, because every insurance company already does this, where they already negotiate these rates. So you want to negotiate them too. The bad news is, so I think the good news is, Bobby, that they're posting rates, but I think our takeaway is keep your expectations low.
Yes, the bar remains very low on this. Yeah. Let's just say, but it's a good idea. At least we're talking about it, right?
Absolutely.
Of actually having a price to a medical procedure that you can see, ideally before, but at least afterwards. So there's some rationale and maybe some accountability. You hear these stories about the $8 Band-Aid. At least now you can call them out on it.
We have a group of people watching us on Facebook, as we talked about earlier. If you'd like to hang out with us on Facebook as we make these, and it looks like our platforms kindly might stay stable for the rest of the show. How about that? Head to facebook.com/iStackBenjamins. But Scott is in the audience and he's going to show off a little bit. He says he thinks that whole big long line of stuff that I read stands for hospital charge percutaneous transluminal catheter closure of patient ductus arteriosus. Obviously, he says.
Thank you, Scott.
And who else we have here? We got Mitchell here from the Pouch Plan. Steve is here. Hey, Steve, our producer extraordinaire for the Stacking Benjamin Show and for Financial Grown Up, Bobby's podcast. Dylan is here. Says that he's going to have to edit this stuff. Rick is here. Rick, back when we were all radio dark, said, I guess we won't learn anything today either. Susan asks if, Bobby, you allowed 3 hours for this because making a half-hour show was going to take forever. And people making fun of me just continues. We have Victor here, Paulette here, Lori's here, Ryan's here. Nice group of people hanging out with us today. Let's move on to our second headline, which our second headline comes to us from CNBC. And this piece, this last week in the news, retail companies are out talking about their holiday numbers. And I found this one pretty interesting. This is written by Lauren Thomas and Lauren Hirsch at CNBC. Retail shares slide as otherwise strong consumer spending didn't boost holiday sales enough. I love that word enough, by the way.
Harsh. Little judgy.
Yeah. Well, and obviously,
right?
Oh, yeah. We're going to get into that a lot more. The piece reads, a strong U.S. customer wasn't enough for department stores to counteract broader challenges facing the industry and investors' high expectations for the holidays. Shares of the country's biggest department stores tumbled last Thursday, led by disappointing holiday results delivered by the biggest department store in the U.S. by market cap, Macy's. Macy's said holiday sales disappointed in sportswear, sleepwear, jewelry, and cosmetics, and it now expects no growth in net sales for fiscal 2018 instead of its previous projection of an increase of 0.3 to 0.7%. The news pushed Macy's stock down enough to mark its worst day ever, closing the day down nearly 18%. Macy's, we thought, was the best of the worst, Stacy Wildlitz, president of SW Retail Advisors, told CNBC. But the deeper but the divide between the survivors and the struggling is every year getting deeper and deeper, she said. And department stores are struggling more than other retailers to maintain any sales momentum as more purchases are taking place online, and brands that typically have received prime placement in department stores are investigating more in their own sales channels. Kohl's on Thursday said holiday sales rose 1.2% over the previous year, a steep decline compared with growth of nearly 7% during the same time a year before. Shares of the Wisconsin-based department store fell by about 5%. Meantime, Target fared better with a holiday sales growth of 5.7% that topped its 3.4% growth in the prior year, but it kept its fiscal 2018 outlook constant, potentially a disappointment. Its shares fell by 3%. Investors, I'm going to skip down just a little bit here, Bobby, which is investors have seemingly been investing optimistically in department stores. They were heartened last year after most major department stores beat rock bottom expectations set by the prior year. The industry in 2017 was just beginning to find its feet amid the rise of online shopping and a slump some labeled the retail apocalypse. We've had a reset, and markets have been so volatile that in 2019, there's a lack of clarity after the optimism entering 2018, said Telsey Advisory Group CEO Dana Telsey. The beginning of 2019 was perfect weather, inventories got leaner, tax benefits helped. The theme of 2019 is margin, said Telsey, trying to clean up the margins. So retail sales flat, that seems like that would make stocks maybe a little flat. But expectations were so high this year that things were going to be better that most retail stocks tanked. Isn't that strange? Like you look at the stock at first and you think, okay, well, this is bad, but I don't know. More and more people shopping on Amazon, shopping online. Now, because analysts thought that we might have a great year, not so much.
So, Joe, this is something, as we talked about, that I used to report on, and it would drive me crazy because you get these stock market reactions. And by the way, I used to work at CNBC earlier in my career, and you get these reactions which are not to the actual news. They're to the expectations. For example, you talked about Target and that their numbers were really good. I mean, they beat their expectations. They came in, they were supposed to do 3.4% growth. They came in at 5.7%. They maintained their 2018 outlook. Okay. So they're like, we're good. We're on track. Everything is working for us. We beat expectations. Maybe they don't want to say that going forward because they want to keep things realistic, and yet they were punished for that. That's not cool, guys. Right. I mean, but seriously, like they're doing well. People are shopping there. They beat their expectations, and they basically said, not only did we do well, but we're on track to continue. Everything's on track, and that wasn't good enough.
And still the stock goes down.
Right. So I think that if you're an investor, not a trader, you have to sort of be able to sort that out. Big difference. And I think that those people that are in it for the long haul, if you believe that Target is a company that you want to be investing in, this should not throw you off. And maybe, I mean, this is, goes to the whole idea of dollar cost averaging. If you still believe in the company and you believe nothing fundamentally has changed for the negative, this could be a buying opportunity if that is a company that you feel strongly about. Knee-jerk reactions happen a lot. And very often when these numbers come out after the bell, you will see a reaction, and then the opposite reaction happens when the stock opens in the morning. And I'm not advocating a trader mentality, but that is just the pattern that we often see. And people should take this in context.
Yeah, absolutely. If you're going to buy individual stocks, you have to know how it works. Like if you're going to water ski, you should probably know everything about the boat, about a little bit about physics, about how you're going to get up on the water ski, right? I haven't water skied forever. I did this summer for the first time.
Anything about physics, Joe, but I'll just keep going.
But my point is you should know a little bit about it when you go in there. And yet people go buy a stock and then they go, wait a minute, this stock did fine. Like the company did fine, but my stock still tanked because some analyst out there said the expectations were going to be higher than what it was. And we didn't fill expectations. But this is never
confirmed that they were going to hit those numbers. By the way, those are just third-party expectations based on whatever information they have. Or they might have a reason why they want to be more optimistic about the stock.
Dylan is surprised in the Facebook group. He said, you can invest in Target. I thought they just freely took my money in the store. You can actually get some of that back by owning the company. You know what you do, Dylan? I would buy one share of stock. I'd walk into Target and say, do you know who I am? Like when you go buy stuff, just say, do you know who I am? And then try to walk out with it. No, I wouldn't do that. Yeah. But I think this is really important. Warren Buffett famously said that he pays no attention to, quote, Mr. Market, right? Which is the short-term knee-jerk stuff. Companies over the long term are going to do what they do based on profits and what they're really doing. But over the short run, for traders, it's going to be about expectation. So when your stock, if you bought Target and you think it's a great company and the stock drops 5%, 3%, whatever it is in a day, it might have nothing to do with the results of the company. You have to wait 3 months, 6 months, 9 months, a year, 5 years, 10 years for that.
Well said.
Let's see what, speaking of well said, let's see what's well said in the, I always get afraid now when I head to our Facebook audience.
Oh my goodness.
Steve is here. Steve said, this was the first Christmas season where I didn't feel disgusted by retail shopping, maybe because I order everything from Amazon and small neighborhood stores. Isn't it fun supporting your small neighborhood store?
Split Amazon and small neighborhood
I
stores.
know, right? I paid the evil empire or the mom pa. Like one or the other. Yes.
Yeah. But I'm cool with the department stores not doing well. I don't know about that. There too, Steve.
Man, when I read The Everything Store, the book, The Everything Store, just seeing how predatory Amazon is. Don't get me wrong. I mean, we live in a capitalist society. Making money's fine. I prefer not to shop there all the time. I'm not anti-Amazon, but I'm definitely not going there first. And Chris says, do you think we'll see a greater trend of companies going private for these reasons?
Oh, hi, Chris.
I think on the retail side, it makes a ton of sense for a retail company to be private. I think a company like Nordstrom, as an example, that operates more on a long-term philosophy, not on a quarter-by-quarter philosophy, I think them being a private company would make a bunch of sense. But can they afford to do that? It's going to cost some group so much money. And we look at when Eddie Lampert and company took over at Sears, Dr. Phil, how's that working for you? Usually when somebody's coming in with loaded pockets, they go in, they raid all the assets of the company, and then, sooner or later the thing's bankrupt. So getting that company to go private, I think, is a difficult proposition. Anything to add there, Bobby?
Yeah, I think that there's definitely been a lot of discussion about the cost of going public. In other words, you kind of sell your soul as an entrepreneur, and is the money worth it? A lot of entrepreneurs are trying to bootstrap more and maybe not take that angel round, maybe the angel round, but maybe not take the venture capital and get on that path to accelerated growth and eventually going public, because they do see the dangers of going public and the external pressures that can interrupt your growth. So I think that is something that we're discussing. But once a company is public, it is very hard to take it private. And as Joe mentioned, it usually comes in the form of private equity. And very often they are repackaging it, doing major construction in a way that doesn't always work out well for the company. It works out. Their goal is to take profit out of the investment. So in terms of being an ongoing retail operation, going private is often not a great long-term plan. But I do think a lot of companies that are entrepreneurial that are coming up now are going to not necessarily rush to go public so quickly. And we've seen that. A lot of companies are taking their time to go public. A lot of names that are out there, like even Uber and a bunch of companies that are on tap to go, Pinterest, that might go public this year, have taken their time and grown without the public markets. So interesting thing to watch, Chris.
No, and it's funny, to your point, Bobby, when it comes to looking at private, like what if, as you're talking, I'm thinking about what if JCPenney had been private when, what was the gentleman's name from? Was he from the Gap or Ron Johnson?
Yeah, I remember I went to that press conference, Joe, and I remember and Ellen came out, and I remember thinking, ooh, this is going to be really hard. Like,
Did you?
Them, but I was at that press conference and I was like, what are they thinking? Because they wanted to be something that they weren't.
I thought it was really exciting. Let's just lower prices. I remember actually going into JCPenney for the first time in a long time.
Sales, Joe. That's not their customer.
Yeah. I'm
telling you, I was there for the ride. I watched it, and there was, unfortunately, among the journalists covering that, I hate to say we were skeptical, but we were. And if there was anyone that could have done it, I believe his name was Ron Johnson.
I think it was Ron Johnson.
Behind Apple Retail, and there's every reason he should have been successful. But ultimately he wasn't, because their customers wouldn't change with them, and they weren't able to bring in the new customers that they thought would be attracted to that, because those new customers were already doing other things. So it was a tough sell. But it was an expensive sell.
Sure. And to the point, though, of had he been private, had JCPenney been private and he'd had a little more time, maybe, right?
Maybe. And maybe they could have downsized in a better way that would have been more manageable and maybe streamlined the way Apple streamlines with not so many products. JCPenney is just, there's just a lot going on there. There's a lot of history. There's a lot of legacy costs going on. A lot of just red tape. It's just hard to move a big ship. And I think that he really would have been, he's the guy. He's a really smart guy. And I think that they were right to bet on him, but it just wasn't meant to be that plan. It just didn't work. I thought he was great.
Yeah.
And I thought it was a great concept, but their customers didn't come along for the ride.
Mike is here. Mike says he agrees with Steve and Chris. Less stressful this year for him, too. Stock price is a moving target. If profits are up but below analyst expectations, stock price will fall. And I think that's, if you're going to play the individual stock game, you have to understand that. Everything can go right for the company. The CFO can call it right. But if analysts call it differently than the CFO calls it, over the short run, you're going to see some ugliness on the stock. And that creates more bumps in the road. I think the lesson here is analyst expectations matter over the short run. I think the company itself matters over the long run, right? Quality products, quality service, doing what you do really well.
And for an investor, the long run is what matters. If you're a trader, it's all about the short term flipping the stock.
Dylan confirms Ron Johnson was at Apple and Target, he says, as well. Dylan says, because Ron Johnson's idea, if you remember, was no sales. It was all fixed pricing. He says fixed pricing works fine at the top tier, but not so much at the discount tier. And that's your point, Bobby, was that that was not a JCPenney customer.
Yeah, I did a lot of reporting on that, I remember. And it was a shame because I get what he was saying. It was madness, the chaos with the pricing, and the stores were disheveled and they couldn't keep track of anything. So he said, we're going to simplify it, do it like Apple, but their customer is not the Apple customer.
Yeah. I remember walking into those stores, though. I thought the redesign was really cool. But once again, I'm not the usual JCPenney customer. So,
well, it was good to clean up the stores.
Sure.
That's never a bad thing. Their stores were a mess. But ultimately, it was very expensive. There was some legal stuff with Martha Stewart going on as well.
Oh, that's right. I forgot about that.
Yeah, that little thing. They didn't fully vet that. And I don't know if we can, maybe I'll tweet a link to one of those stories afterwards so we don't go into that. But there was some legal trouble with the deal they had with Martha Stewart. And so, yeah, it was a tough road, but he's a smart guy.
In just a second, we are going to have our big idea for today where we take both these headlines. How the heck are Bobby and I going to take the stuff going on in retail and marry it to hospital pricing and actually seeing what you pay? Well, we'll have that in just a second. But while we're talking hospital pricing, we were talking about insurance earlier. An insurance company that we like here at Money in the Morning is called Lemonade. Lemonade is where I went for renter's insurance when I was there. Also, at our new house here in Detroit, went with Lemonade also. Forget everything you know about insurance. Insta everything, killer prices, big heart. It was so easy, Bobby. I took the Lemonade app. I downloaded it to my phone. Well, I didn't even do that. I started off just at the website. So if you just use our stackybenjamins.com/lemonade link, that tells them that we sent you. And the way that we keep the podcast going is by...
Very important. Most important thing you've heard here today.
is by having used that link. But then It took me 90 seconds to get a quote. It was amazing. And I was blown away by the quote. And maybe you will be and maybe you won't be. When I see people get quotes and they write to me, some people get blown away. Other people don't. It depends on your area, depends on the type of structure that you have, but it takes 90 seconds to maybe save a bunch of money. stackybenjamins.com/lemonade. I love these fintech companies that are making it so much easier to do some of these mundane things like homeowners insurance or renter's insurance. Good stuff there. All right. So we started off the day by talking about hospitals and about hospital pricing. And then we went from there to talking about retail stocks. And at first, retail companies, some of them, like Target, did okay. And yet across the board, stocks went through the floor. Why? Analyst expectations much higher. So it wasn't a great season, but with so many people shopping online, so many people moving, like Steve in the comments, to Amazon, the year was definitely depressed since last year and didn't meet expectations. And because of that, these companies not doing what you might think they would do at first blush. At least the stock would stay the same. And maybe in some cases, like for Target, they'd go up. On the other side, we had hospitals doing something we all think is awesome and sharing their prices. And yet when you actually look at this pricing stuff they're showing us, you can't read this stuff. You can't read any of it.
Scott Steenberg can.
Yes. Just bring Scott Steenberg with you whenever you go to the hospital. Call up Scott. So I think our big idea today is this. Often, Bobby, when it comes to investing, comes to news that you see, you read the headline and you think something's one way, and then you dig in, and that might not mean what you think it means.
Yeah, you have to actually read the print, not just the fine print. Read all the print. Read it, know what you're getting, know what the price is. No, you're laughing, Joe, but you know what? A lot of times it's not even in the fine print. It's right there.
I'm also laughing because how many times have you seen that on Facebook where somebody clearly only read the headline and then you dive into the piece and you're like, yeah, I don't think this person wanted to share that. Like that wasn't at all what they thought that it was going to be. So fun stuff. All right. I think that's going to do it for today. Bobby Rebell, thank you so much for saving the show.
Joe, thank you for having me. And thank you to our Facebook audience. You guys are amazing.
Tell everybody what's going on at your other podcast, Financial Grown Up.
Financial Grown Up. We interview high achievers about money stories and we get their advice, everyday money tips. And high achievers there have included you, Joe Saul-Sehy. So check it out.
Hey, let's talk about you and I doing this show together, because for those of you who don't get our Stacking Benjamins email, the Stacker, don't follow Bobby on social media where she was talking about this earlier, aren't in the Basement Facebook group. It's from here on out, it's going to be Bobby and I doing the show. You might see we have brand new, much better cover art, way better cover art. and
because I need some coffee, Joe.
This show is going to change a little bit. You know, in the past, it's been based on my take as a financial planner for a long time. But Bobby, you've been in, you know, I talk about people teasing me about saying that I was in the trenches with families. Well, you were in different trenches. You were in the financial.
Yeah, so people heard a little bit about my news background, and I am technically a certified financial planner, but I've never actually run a CFP business. My background's all in journalism. So I hope to bring that perspective to people. Like I said, it just came up. We didn't plan it. The fact that I was at that press conference with Ron Johnson talking about how he was going to totally turn the tables and revive JCPenney in a totally unexpected way. And he worked the magic from Apple and all that stuff. So I hope to bring people a different perspective, and especially when we talk about these news stories, to kind of understand what's going on behind the scenes. A lot of times I know the reporters, I know the people that are sourced here, and I can give you some context to where they're coming from, because things, as Joe mentioned, are not always exactly what they seem.
Yeah, I'm so excited about where the show's headed. So for the next few shows, you'll have Bobby and I together, and then we're going to split the shows where sometimes you will get Bobby's experience and headlines that she picks that really lean on that experience. And then on other shows, you'll get my experience working with families. So it's going to be incredible. And then from time to time, you'll get this duo back together, and hopefully, Bobby, with a more stable platform than we had today.
Well, and right now, Joe is running the show. Basically, only one of us sort of runs the technology at once. And I'm just going to tell you guys to brace for it and be patient with me, be kind and supportive, because there's a lot of technology happening to make this show happen. And it could be a little bit ugly, but we'll get it done.
It's going to be... Well, it won't be any uglier than it's been in the past. Long-time listeners to the show know there's no way to go but up. So anyway... No. That's going to do it. That's going to do it for us today. Thanks, everybody who hung out with us today on Facebook. Thanks to everybody listening. Go stack some Benjamins. We'll see you next time back here at Money in the Morning.
Money in the Morning is created by Joe Saul-Sehy and comes to your ears because of the collective genius of our producer, Richie Rutter-Reese, engineer, Caden Thompson, and a pack of very well-trained ferrets here in the basement. You'll find links to all of our headlines featured on today's show in Joe's Twitter feed at @AverageJoeMoney. I know you already know this too, but Money in the Morning is for entertainment purposes only. You shouldn't act on anything recommended by a bunch of entertainers in a basement without first consulting with your financial advisor, and second, having your head examined. Have a headline you'd like us to discuss? Send them to joe@stackingbenjamins.com or put them on our Stacking Benjamins Basement closed Facebook group. This show is copyright 2018 Stacking Benjamins LLC, all rights reserved. I'm Joe's mom's neighbor, Doug, and I reserve the right to always say, We'll see you next time back here on Money in the Morning.